Tariffs are roiling the markets. Investors everywhere are panicking. And you're thinking you need to play 4D chess with your investments just to get through the craziness. Well, Steph Den would beg to differ. These DIY investors hold just one investment in their portfolios, and they're resting easy through this market panic. So let's find out what it is. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for a third straight year and counting. I'm your host, Rob Moise. We've got a fantastic show lined up for you here. We're going to be keeping things simple with our investing through times of panic. That might just help your bottom line. We're also going to talk about secrets to keeping your bank account and your relationship healthy. Plus, we're going to answer your questions on all things investing later in the show, so stay tuned for that. We've got lots on the agenda here, but let's bring in our special guests for now. Joining us are financial influencers Stephanie Gordon and Dennis Mathu, aka Steph and Den. They're the millennial power couple, if you will, that turned their love of personal finance into a full-time career helping others make sense of their money. And they're pretty popular on social media, too. They've got nearly 700,000 followers across their various accounts. Steph and Den, welcome to the studio. Great to have you guys here.
Hello.
Thank you for having us.
Yes, thank you so much.
By the way, I just got to ask, did you guys color coordinate this, or are you guys just like naturally simpatico here at this
We're
point?
naturally just aligned. I feel like we're always...
We're just locked in.
Yeah, I do love to match, though. Whenever it accidentally happens, I'm very excited.
Well, you guys are looking great. You guys are feeling great through all this market panic, which we'll talk about in a little bit. But before we get into all of that, I just want to know a little bit more about you guys. Yeah. How did you turn this side hustle that you guys had into a full-time career? How did that happen? Take us through it.
Oh yeah, great topic and questions to start off with. So the two of us, ever since we first met back when we had a summer job in university, so that's how we met originally, we always talked about money. It was one of the first conversations we had. I feel like people ask, how does that happen? We were just open about these topics. We talked about what our first salary was or what our salary was at that job. At that time, Spoiler, he made more than me, and I was very curious about that, so that opened up a whole interesting conversation as well. And it's just something we always talked about. And then when we graduated from university, we moved to Toronto. We had our corporate 9-to-5 jobs, both working at big firms. And we wanted some sort of like creative outlet that was fun. Yeah. So we kind of mixed this topic that we were interested in that's more serious, which is money, and also careers a little bit at the time, and negotiating your salary, those type of topics. Yeah. And then we mixed that with this creative fun outlet of videography and making videos and putting that together.
Yeah, it basically just transitioned from that creative outlet to, us eventually doing this full time, which is crazy to think back on. Yeah, it's funny because when we first started, it was that creative outlet, and then it quickly became, we're kind of more serious people naturally. We see the path forward in things, we take it seriously. Intentional, what we do. Intentional, I think, is a better word than serious. Yeah. So eventually it became something we knew we wanted to do, and a few years into starting, we ended up doing it full time, and now it's been several years of full time content creating. Which sounds crazy.
Yeah, well, I mean, any tips for those? I mean, this is like the Gen Z millennial, dream scenario, right? Where you turn like a passion into a full-time career. Any tips for anybody who wants to get started kind of doing the same sort of thing?
Yeah, good question. A few things. I think for us, it's a mix of we had a plan and we knew what we wanted to do, but also being adaptable and being able to switch up that plan consistently and checking in. That was huge. So for us, when we had our full-time jobs that were steady and secure and stable, it's hard to make that jump to leave it, but we wanted to do this thing that we knew was impactful, and we were actually having an impact on people, talking about and educating about money. Yeah. But we also had the fun creative side. So we had our plan of what we wanted to do, but what we would have, I can't even imagine what our notes looked like for our plans back in 2021. It's probably not doing anything similar to that anymore, right? So things have adapted and changed over time. So being adaptable on top of the plan you have.
Yeah, and just being intentional, right? If you really want to do it, you will make the decisions that you need to make in order to actually get to that point. And the intentionality piece is huge. Yeah, it's huge.
One other thing I'm curious about. So we know obviously you guys are romantically compatible, but when did you guys realize you're financially compatible too? Was this first date material, or did it take a while for this to emerge?
Yeah, I feel like we always talked about money, even from the beginning, right? Like listening to different podcasts that were money podcasts together.
Yeah, I feel like that was a big part of it. Dennis was always really interested when we first met in different financial podcasts and books. He would send me articles all the time. I feel like that was huge. And I like talking about anything that's interesting. I always found money interesting as well. So I think that was big, is being open and talking about it together. That's how we knew we were compatible. But we have very different backgrounds with money and our financial, and our upbringings too, right? So being compatible doesn't always mean being the same and having the same path, but it's being open and having the same bigger picture for the future. And I think that was just through those conversations we had openly what we found out.
Yeah, we had different takes on a bunch of different things, but it was was interesting, you know,
Yeah,
like talking about it.
Made it fun.
The ability to meet in the middle where you need to, and respect differences elsewhere. Awesome stuff, guys. Appreciate it.
Yeah.
I'm curious to see how you guys are handling this market volatility together. So let's get into the heart of our conversation here, and that is how you've simplified your investing strategy down to just one investment. I think this is pretty wild here. And for our audience there, if you want to get in on this conversation, we'd love to have you too. So what you can do is you can submit your questions for Steph and Den, and they'll take them at the end of the show here. So if you're watching on Webbroker, you can use the chat box to send your questions to us. If you're on our broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, just click on the link in the description. It's going to jump you over to our broadcast platform, and you can ask your question there. So without further ado, guys, let's not keep people in suspense any longer here. What is this one investment that has you guys sleeping easy during all this market panic?
Yes. So for us, we both invest in an asset allocation ETF. It's also called an all-in-one ETF or a one-fund solution. Essentially, it's an ETF, an overarching one, made up of multiple other index ETFs inside of it. So passive funds that track the market, globally diversified is a big piece too, but all wrapped up into this one ETF that's the one we're actually purchasing, which makes it very simple. It makes it so that we're not having to rebalance or do that work consistently, manage multiple different investments. So just one fund that we're buying, but it has a bunch of diversification included inside of it.
Right.
Yeah.
And I think like a lot of people would hear like, okay, you're only investing in one thing. That's got to be really risky, right? Because you don't put all your eggs in one basket. Take us through, when you say diversify, like what are we talking here?
Yeah, good question. So I feel like that's a big quote that we say all the time too. You want to diversify, you don't want all your eggs in one basket. The thing about these all-in-one funds, or just funds in general, is that you're already diversifying naturally. So if you were to buy one individual stock from one specific company, that is putting all your eggs in one basket. If that company were to fail, they shut down, they don't exist, your money's gone if that's your only investment that you have. These funds have hundreds or thousands of stocks inside. The one that we invest in has thousands from different countries around the globe. And so you already are diversifying, but it's made it simplified so that you yourself can still just be purchasing this one thing. It's kind of a mix. I feel like there's always a trade-off with investing between cost and then your time. So this makes it simple, and it's still a low-cost option, which is great.
Yeah, and for us, if we think back to how we even got to this point, it definitely was not as simple as it is now.
Yeah.
Like if I think back to your journey as well and my journey, like my journey started off with crazy amounts of student loan debt before I even got to investing.
Yeah.
And for her, she didn't have the student loan debt, but it started off with
budgeting and saving.
Just the investing piece and you investing a very small amount at the beginning, right?
Yeah, and this is what took us to this point where I was able to simplify and kind of put everything that we learned on our journey of investing and what we've learned all together into this place.
Yeah.
Yeah.
So, I mean, I like the idea of keeping it simple, stupid, right? Like that's my motto in life here. I think that some people, though, might wonder with all this market volatility happening, like, yeah, sure, you're diversified, but like a lot of the markets are going crazy right now. What makes you stick with this simple is better approach basically to investing through all this up and down?
Yeah, great question. I think that kind of nods to the journey Dennis was touching on before too. So when we first started investing, well, again, I started investing first before Dennis because he was paying off his student loan debt. I started investing for the first time, a very small amount of money. It was in mutual funds that I was not handling or involved in at all. Then I started to learn that I don't need to pay someone else so much money to invest for me. How can I do this on my own? But I wasn't at the stage yet where I was confident on investing on my own. So I used a robo-advisor to do it for me. They naturally were investing, this algorithm that is the robo-advisor, in these passive ETFs. But then I realized after a few years, I didn't actually know what these funds are because I'm not doing it. It's the beauty on one hand of a robo-advisor, but I also realized as I grew my knowledge and confidence over time, which is one of the main topics we talk about, growing up your investing knowledge and confidence because you have the ability to do it yourself. Once I learned that, I realized, okay, I can do this on my own, but I do want to have something simple still that's easy, I can stick to for a long period of time, and that's where we landed on the one fund solution too, which Dennis at this point had also been investing in as well. In terms of talking about this time, maybe you want to jump in.
Well, I was going to say, so there's that side of it. And there's the other side of, for some people, maybe they do start off more complicated, which is kind of where I started. I started off trying to put together factor investing, which, to me, at the time, given the job that I had and, us working ridiculous hours, it just didn't really make any sense. And I think for the average regular person, you're just... do you really want to be putting the amount of time that it would take for you to ultimately, statistically speaking, lose money? So for me, it just made sense to really simplify it, and eventually landed on well, yeah, eventually landed on an asset allocation ETF and kept it simple.
Jump in on that too, because we've been touching so far on the one side, which is our time side of it, keeping it simple, which is true. The other thing that I feel like really made it so that this is something that we're going to stick to for the long term and for as far into the future as we can see is the actual research and stats behind the fact that passive investing in these funds over the long term tends to result in better performance than active investing and trying to time and beat the market. So once we learned that not only is it simpler and takes less time on your hands, but it actually statistically the majority of the time will lead to a better result anyway over the long term, it became a no-brainer that that's something we want to do. And especially during these times when things are scary, it's nice to know that we have the knowledge and confidence now and that we have this simple fund that's diversified that we can stick with during this time.
You know, speaking of that too, not being able to outperform the market, so to speak, we actually have a great chart called Measuring Up here that maybe we can call up here, and it looks at the performance of, in this case, Canadian equity funds versus just the broader S&P TSX Composite Index over like the long term.
Yeah.
One or 2 years, you know, yeah, maybe the active funds will outperform, but over the long term, it's something like, you know, 90% here that the market is going to beat you. So I totally appreciate, you know, at least historically speaking, why that approach could make sense. One thing I'm hearing in the markets these days, though, from a lot of investors is, but this time feels different, right? Like something feels off. Yeah, I know, like in the past it's worked out, but I don't know, just my spidey sense is tingling.
Yeah.
Is your spidey sense tingling? Yeah. How are you guys thinking about this? Is this time different?
Well, this is the emotional piece, right? This is the emotional side of investing, and I think eventually you kind of build that confidence in what you're doing over time. And you know, to give you context, for us, we've seen in the last, I don't know, month or so, our portfolios have been going up and down like crazy. So we know what the people are seeing, we know what we're hearing, but at the end of the day, we've heard that sentiment before. We've heard people say that before. If we're looking backwards, we're looking at the 2020 pandemic. That was different. The 2008 financial crisis. That was different. You know, if we go further, that was different.
Yeah. I think something that Dennis touched on there that's really important too is that money is emotional and investing is emotional. So
Absolutely.
when you have a knowledge gap or a confidence gap, I feel like those two words always go hand in hand for me. You're building up your confidence when you have more knowledge, because knowledge is the empowerment piece. You have that gap if you haven't lived through something before. This time might feel different because it's the first time you're going through it, or maybe the second or the third, but it's different than those first two times. So that's where the fear comes in. But if you have the knowledge of what's historically happened in the market before, the fact that historically speaking, no matter what is causing the dips in the market, it trends upwards over the long term, and based on history, we expect to see that again. That's what can carry you through that too, that confidence.
I love that chart that we had up on screen here too, that staying the course, because you think about all the terrible things that have happened over time.
Yeah.
You know, the market's going to crash because of this, that, and the other thing. And then every single time it's seemed to find a way to recover here.
For sure.
So I hear what you're saying, like, you know, the flavor might be different, but the general meal is kind of the same, right?
Yeah.
At least we hope so, right? At least that's the expectation. However, I'm going to put you guys to the test here.
Yeah.
Because it's all well and good to say this, you know, when the stock market dips like 20%, you're like, yeah, I could ride it out. What about if the market goes down like 50%? What about if we see something that's like Great Recession or, you know, depression kind of level stuff? Your portfolio is cut in half.
Yep.
Do you guys think you could stick it out then?
It's interesting because even the sticking it out or being able to stomach things too, I feel like that still goes back to the emotional piece. And do you have the knowledge and confidence in what you're specifically investing into? The fact that we're passive investors for the long term with many, many years, decades to go until we want to actually take anything from our investments, until we retire, yeah, there's nothing that we would change if that happened because we have that knowledge and confidence. I will say though, you don't reach a level where all of a sudden you're good, you don't need to learn anymore and your confidence is good. You get tested when these times happen.
Absolutely.
Yeah, seeing it, it's not fun. I'm like, oh, I don't like looking at it like this, but I know it's all for the course. I know that this is many years in the future. Even if it feels like I've been investing for years now, I am very early on in my journey when it comes to the long term, as are you.
Yeah.
So our response to that, is we would do the same thing. We would not change up anything. We'd continue to work on our knowledge and confidence. And for anyone who is concerned, it's actually a good time to continue to learn more and build up that confidence. You still need to analyze your portfolio. Maybe you're someone who's not passively investing for the long term. Then it's a little bit of a different situation. But if you're a passive long-term investor, then there's no reason to be scared in those times from an investing standpoint specifically.
Yeah, I wholeheartedly agree.
I should say I'm surprised, but I'm not surprised. You guys are so simpatico here. What about this? One of the things I've heard in the market here from people who are more of your mind where, you know, hey, I can ride this out, buy the dip. What do you guys think about buy the dip? Is it something that you guys are personally doing, or is it just like business as usual, like you're literally not changing a thing?
Great question. And we actually kind of outlined all the different options in some content that we did recently for our audience, which is, you have a few options. You can panic sell your investments. I'm not saying good options, by the way. These are just the options. You could panic sell, you could do nothing and freeze and pause. I actually had a friend come up to me at a party the other week saying that they're like, I haven't done anything for the last few weeks. Should I just wait and see what happens? I know I shouldn't be selling, but what do I do? You could buy more, or you could just do what you're always doing. That's the little option 4 that I feel like people don't think of, because they ask us, are you selling, are you doing nothing, are you buying the dip? We're doing what we're always doing.
Yeah.
And what that means is we're investing a consistent amount every single month. It's already as much as we can afford to, so there's not really much more to squeeze out of that. And then an extra lump sum whenever we have that money. So we would continue to do that now. So if that's buying when it's at a dip, yeah, great. If we have the extra
money. The money, yeah. And
if we have it, we would do that.
I think that's a big piece for the vast majority of people. Like, the vast majority of the population just doesn't have, an extra however much money just sitting around waiting, right?
Yeah.
You're getting paid bi-weekly or monthly, whatever that is, and you're investing what you can afford already. So, based on that, just keep it pushing.
Yeah.
Whatever you're doing before, just keep doing it.
You guys are cool cucumbers through all this craziness, so good on you guys. That said, for those in our audience here, maybe you're not as cool as a cucumber here. The volatilities can be a lot to handle. So if to Steph's point, if you need to level up that knowledge gap that you have and get a little bit more comfortable with what you're doing or reassess what you're doing, check out TD Direct Investing's content here, because we have a ton of educational content that's specifically around dealing with market volatility. You can find it in our Learning Center on Webroker, TD's YouTube page, our Instagram account, all that good stuff. And that's it. If you feel like you're getting educated, but you're like, I need a little bit more help here, this is just a little bit too much for me to handle, scan this QR code on the screen. It's going to take you over to TD's tailored financial solutions, where you can speak to an advisor. Maybe they can design something a little bit more specific to you that can help you ride out this volatility and figure out where you should sit. So check that out if you're interested. That said, before we continue, we got a lot more to get to, but I have a quick question for our viewers here, on a lighter note, of course, here. We're talking all this market volatility. Do you like free stuff? If you like free stuff, then check out this contest, all right? Roll it.
The TD Ultimate Investor Contest is officially live. Canadians can enter today for a chance to win a black iPhone 16 with 128 gigabytes of storage, a check for $500, a book kit featuring 5 educational books on investing, and a 1-hour private Q&A educational session with a TD Direct Investing Education Manager. To enter, visit the TD Direct Investing Facebook page, follow TD Direct Investing, and like the TD Direct Investing contest post dated March 24, 2025. You can also gain a second entry by following TD Direct Investing on Instagram and liking the TD Direct Investing contest post dated March 24, 2025 there as well. There's a limit of 1 entry per entrant per social platform. The contest runs until April 22nd, 2025. Scan the QR code for full contest rules and details.
Time is running out in that contest, so make sure you get your entries in. You don't want to miss it. Guys, I just want to pick up on another topic that I've heard a lot of here in the market here, specifically when it relates to passive index investing, which you guys are now full board with asset allocation ETFs here. And that's this idea that you can't get rich doing this, right? Like that you have to take some kind of excessive risk through the ups and downs in the market, whether it's like speculative investments, crypto, penny stocks, whatever the heck, or even just like an all equity portfolio, right? Yeah. What do you think about this idea that passive investing is just it'll help you chug along, but you can't get rich doing this?
That's a great question, because we see people ask that all the time. Either you can't really get rich doing this, or if you talk about the timeline that it's getting rich over time, oh, but I might not be alive then. I want to spend all my money now. I want to be rich now in the short term. I feel like there's 2 questions to touch on when it comes to that. One is, what is rich to you? What do people picture as rich? Yep. We actually saw this really interesting video the other day. I think it was specifically interviewing Gen Zs on what would be a comfortable salary to have, and it was over like $500,000. That's what they thought. To be comfortable, you need to make over $500,000. That was a real survey that they did from people, right? So if that's your mindset, then yeah, you have a very different benchmark of what rich is for you. But you can get very wealthy statistically, and it's been proven for people over time. You can get very wealthy over the long term by taking the simple approach and passively investing. And I also want to highlight too that the long term to people, I feel like when you're young especially, a few years feels like a long time. Like sometimes when you say long-term investing, people are picturing that being 3 years. Yeah. Long-term investing is decades. But you really start to see things change once you hit that $100,000 mark and then the $200,000 mark. Things start to snowball much faster than you actually think. I even think back to me and both of us in our journeys too. A few years ago, now would have felt like so far into the future, and it felt like I blinked and we're already here. And so much has changed in my investment portfolio over that short period of time, passively investing throughout that entire time time too. So I feel like those are the big things to highlight.
Yeah, I also think once you get burned on those some of those single stocks or whatever it is, your crypto or your options trading, then you kind of have a different taste in your mouth when it comes to taking some of these risks.
That's such a good point too, because you see the success stories, right? You see the small percentage of people who take these risks, these gambles, because that's what they are, and these different speculative options, and it works out for them. Or they're attempting to beat the market, or it works out for them, especially over the short term, because anytime you're hearing these stories, it's over a very short period of time, and then that makes you want to try it. But for every one person that works for, there's literally 9 people that it failed for, right, or more. So you have to look back and picture future you and what you would have preferred that you did in hindsight, I feel like is an important way to do it.
Right. We only ever hear about the good YOLO stories.
Yeah, you do.
I lost my shirt stories. Nobody wants to tell these stories.
No. Yeah, they want to look at that percentage.
Dan, I want to ask you something too, because you brought up an interesting aspect here. When you were starting out, you jumped right into something called 5-factor investing, right, with your approach. It's something I also tried to dabble in personally for about 20 minutes before I was like, this is way over my head and stuff like that. How did you, I'm just curious, like, how did you get to the point, because the rationale for that is often that, I can optimize my portfolio and squeeze out a little bit more. How did you get to the point where you're like, I just don't think that effort is worth it, and I'm going to go with something simpler?
I just think it doesn't make sense for the average regular person who is working in a regular job. When it comes to the amount of time that it took to rebalance, or even the amount of research that I did to even get to that point, right? It would have been so much more simpler had I known. Obviously, hindsight's 20/20, but it's like you can spend so much time trying to optimize your portfolio, but in the real sense, we forget about, user error, for example, right? Like you making a mistake, you buying, not exchanging currencies properly. Like there's so many things that you can make mistakes on that it just didn't make sense, overall.
I want to jump in on that too, because it's such a good point. Dennis, especially early on, was like, oh, but if I put in this extra time, I can squeeze out these little bits of efficiency, right, and make it just this little bit better. But if you balance the amount, kind of cost-benefit analysis to it, the amount of time you're taking to get this little amount of extra efficiency, is that worth it? And if you want to take the time to do that in certain ways, maybe you can. But for the majority of people,
am I going to be able to execute it to perfection
all the time?
Right? Does that make sense? Am I going to be able to do that over the long term as my lifestyle changes, for example, right? People move into different phases of life, and maybe I could have done that in my early 20s, but as things change in your life, do you still have the time, and are you even doing things the way that they should be done? If that makes sense.
I hear you. The error ratio that you can kind of run
Absolutely.
into. Listen, I make mistakes all the time, just like my wife, so she can attest to that. But yeah, I kind of came to the same conclusion myself, and realized it wasn't for me. One last question for you guys. You mentioned long-term. If you're a long-term investor, it doesn't matter. You guys are both long-term investors, you have a long time horizon. What is long-term? Like, at what point do you think you have to make that mental shift where it's like, maybe I do have to jump in and do something different with my portfolio? What do you think that line is? Yeah,
it's a great question, because especially when you're younger too, long-term means many decades into the future. Really, all that long-term means is you're investing for retirement. So until the point where you're no longer actively contributing to your investments anymore, and instead you're starting to withdraw and take from them. So that's basically when you retire, specifically if you're retiring and no longer bringing in any income at all from your actual salary and these different income sources. So once you're getting closer, for us, we like to play around with the 5-year mark, but it could be different. It's very situational for people. But once you feel like you're approaching retirement and you want to start making those plans to get towards that, that's when you might want to shift things in your investment portfolio. I will say, though, that I think people have their mindset that once you retire, your investment account stays static and you're withdrawing until it completes down to zero. That's not the case. Your money, ideally, a lot of it is staying invested and could continue to grow for many decades to come. Hopefully you're retired for many years. So there's that balance too. So there's a lot more that goes into the retirement planning side. If you're young, the long term is decades. If you're approaching retirement, then you want to start thinking of it when you're actually getting closer.
Yeah, it's funny that you say that, because you're talking about, like, people think they need like $500,000 salary a year or whatever like that. I think personally just the same thing about some of these salaries or surveys rather, where it's like, I need like $5 million in retirement to make it worthwhile. It's like, is no one making it out there? Like, how many people have that much, right? Like, I think we do overestimate. Anyway, thank you guys for sharing your perspective and how keeping it simple has kind of worked for you guys, been the secret to success here. We got a lot more to come. But before we continue, quick question for our viewers here. Are you enjoying the show so far? Then make sure to follow TD Direct Investing on YouTube, Instagram, and Facebook. You can get a sneak peek at upcoming episodes and a ton of other content designed to help you build your investing knowledge. Okay, Steph Den, one of the things that couples often have difficulties with is talking about money, of course. And so I wanted to bounce some ideas off of you guys, see if how you guys think about they could navigate some of these money issues. And I think one of the ones that folks often run into a lot is getting on the same page with their money and figuring out, are we compatible financially? So take us through, like, what do you think are some best practices to help realize if you're on the same page as somebody financially?
That's a great question and very important too.
Yeah. Start talking about it early and often.
Yes, that's the high level tagline for it.
Yeah.
So the biggest thing is start talking about it right away if you can. Now for anyone, I'll get to you in a second. If you're already in a relationship and you're not talking about it, what do you do? But starting from the beginning, just have these conversations about money. We obviously did early on, and that helps, that open line of communication. Another piece to that too is I think when people think about talking about money, they're thinking about these tangible, specific things. What are we going to do with this? Should we open up this account? What is your salary? Things like that. Those are all great conversations to have, and we should be having those too. But it's kind of more the qualitative and emotional side first. You can ask your partner, what makes you the way you are with money? What did your parents talk about money? What was their financial situation? What did you hear about? What were the lessons? People in general like to think that they don't want to focus on money, but it's involved in your life every single day, no matter what, whether you're thinking about it or not. The things you do, the things you don't do are often driven by the money you have or don't have, or the way that your parents handled things. That's such a good starting point to have. So that's a big piece. And then in terms of actually pivoting to, are you compatible or not? Like we kind of touched on with us, with our stories, we have different financial backgrounds and just upbringings in general. So it doesn't have to be compatible from having the same story. It's what's your outlook and what do you want moving forward as well, and having those conversations to get on the same page. That's pretty much the big piece.
And I feel like speaking more on the qualitative side of things, like you're gonna see things come up in your relationship, right? So you might not attribute them to money, but for example, you might have one partner who loves to leave the soap bottle for as long as possible, so they're constantly filling it up with water, and it's causing, some sort of small little issue. But it's like what? How differently did we grow up? That's and why is that coming out in that way, or certain things, right? Certain small things that might not seem like they're money related, but really they are in terms of how you were raised.
And if you've had these conversations, you can understand them more. One for us, that's a big one, is that for our first several years of our relationship and living together, Dennis never cleared out his closet. You were just adding to, you didn't want to get rid of older clothing pieces. And to me, I'm like, oh my God, why are you not just getting rid of that? But it's a different mindset on money. Why would you just throw something away if you could still use it, right? Yeah. There's that, even if you're donating it, by the way, not just throwing it away. But yeah, there's that whole piece. That's technically a money conversation that you're just not thinking about.
Yeah, I mean, I grew up with, we don't throw things away, right? Or we don't, anything. Basically, anything can be used, right? That was the mentality, right? So, that's just how it was.
And I will say too, if you want to actually start having these conversations, especially if you're someone who, we've been in this relationship for years and I'm realizing now we don't actually talk about money. How do you start?
Yeah.
I think a big one is if you're the person in the relationship that wants to start having these conversations, offering up something first and being vulnerable first and sharing on your end, telling them why you think it's important, it makes people more open to, instead of just asking a question without offering anything on your end. I think that's a big piece.
All right, great stuff, guys. One more question for you here on the Love and Money file here. And it actually relates to investing here, risk tolerances. We often have different risk tolerances, and you might want to invest together towards a common goal. Maybe it's saving for a down payment or what have you. How do you reconcile that as a couple, do you think? When you have different risk profiles, what can you do?
Great, yeah, that's a really important topic, actually. This is something that we dealt with early on in our relationship, too, because we were very open and always talked about money, but we're in different stages of our comfortability and knowledge, right? So Dennis was much more comfortable with starting to invest. He was actually in the phase where he was paying off his student loan debt, but I could have started investing, and he wanted to continue to help me do that, but I was scared. And I'd had that knowledge gap and therefore that confidence gap. So he would share articles with me all the time. He would actually inform me. I would do my own research. So it's really, in general, risk tolerance is a mix of the emotional side and the knowledge gap piece, and then your actual time horizon. If you have the same time horizon in a relationship, but one of you has a different gap in their knowledge and isn't confident because of that, you can actually change that. You can grow that and fill up the knowledge gap to have the same side. But then it's different if you are different ages. Yeah,
well, I was going to say, risk, when we're having the conversation about risk tolerance, we kind of look at it in only one specific way, but really it is the education piece and the confidence piece, right? Because if we do have decades up until we need this money, you have the ability to take on higher risk.
Yeah, if you have a long-term time horizon, you have the ability to be more risky in your portfolio. It's just making sure you're confident with that and understand it so that you won't panic at a certain point.
Absolutely.
So filling that knowledge gap and empowering the other person in the relationship is really important. Now, if you're different ages, then it's going to be different, right? If someone's 10 years older in the relationship, they're going to hit that time where they're closer to retirement first. So that's when things might differ. But overall, it's getting on the same page with the education piece.
Yeah.
Okay, so there's the power couple on money dynamics.
Yes.
I appreciate it, guys. Thank you. We have another segment that we like to get to. We call it Hot Takes.
Yep.
Right? We've heard a lot of interesting perspectives in the past here on our program, and I want to know whether you guys agree or disagree or what have you like that. So I'm going to throw some ideas at you guys. You guys let me know whether you agree, you disagree, where you differ. How does that sound? You guys good with it?
Great.
Yeah.
Okay, so I'm going to get to a clip here that we have. This one is from Sandy Yong, and she was talking about how there's value in potentially trying to buy the dip during a downturn, and it could be a really savvy move for investors. Let's listen in.
Yeah.
A lot of people are fearful, which I mean is totally normal. But if you do have the opportunity to invest more money into the stock market while it's down and could be continue to go down for weeks, if not months, who knows? So much uncertainty out there, but it could be an opportune time to put more money and invest it for the long run.
So we know you guys both like buying the dip here. Rather, you don't bother to buy the dip in the sense that you're always constantly investing. But for someone who does buy the dip, what do you think would be a good approach to take so that they're doing it in a way that can make sense for their portfolio long term? What do you guys think?
Yeah, so like Sandy touched on too, it definitely is normal to be fearful. Hopefully we're getting people past that knowledge and confidence piece where they're not fearful and they know that over the long term, we're long-term investing. So buying the dip shouldn't be scary. I will say though that sometimes when you're buying the dip, well, in general, if you're buying it, you are still timing the market. You're not timing it when you're going to sell, you're timing it to try and buy at its current lowest peak, right? And right now, we've seen the market go right back up again, it might go down again, we don't know what's going on, right? So when you're buying the dip, you're still trying to time it, right? So that's why we like to go with that option 4 that we touched on before, where you're doing that same thing consistently, and you're not trying to analyze, oh, is this the exact day that I think it's going to go down? Because that is a guess at the end of the day. I think that's our main piece to touch on with buying the dip.
Yeah, if you have the lump sum, then by all means. But for the most part, it's keeping things consistent. Yeah.
I'm not trying to say this is the exact time. I know this is the lowest it's going to be.
Well, and sort of quickly on that note, then, one of the things that people sometimes talk about doing is lump sum versus like kind of averaging in the money.
Okay.
Yes.
So let's say we're in a volatile market like that right now. Are you guys lump sum? Let's say you have some money in your hands. Are you lump summing it all in one shot, or are you going to sort of try to average it out a little bit? What would you guys do?
That's actually a great topic too. We did some research onto this, in a video last year too, on just in general dollar cost averaging versus lump sum investing. And it's one of those things where you never know until actually in the future when you see what happened during that period of time.
Yeah.
Statistically, and there's been a lot of different research and studies done on this, lump sum investing tends to result in a better result majority of the time. It just depends on what's currently happening. Now, in a time like this, we know that things are going up and down, but in general, the philosophy of getting your money invested earlier and having it for a longer period of time, especially when you're early on in your investing journey.
Time in the market,
in the market tends to result in better outcomes. So for us, if we had a lump sum, we would invest it in one go instead of averaging it out. But then on a monthly basis, we do invest that amount.
We would still be putting our regular contributions.
So we do a bit of both.
Yeah.
Dollar cost averaging on the monthly basis, lump sum investing whenever we have it, even during this time.
Unflappable in the face of chaos here. I love it. We got one more idea for you guys. This one's from Simran Kaur from Girls That Invest. And she shared a simple 3-fund ETF portfolio that she feels can work well for beginners.
Most people end up choosing 3 different funds to create a portfolio. And these funds one will be a fund that is relative to your local market, your home country. So in this case, it might be an index fund of the top 200 or 500 companies in Canada. That's you investing in companies and home that you believe in, that you're seeing growing. Then you might put some of that money into a US fund, and that might be the top 500 companies in the US. And then you might have one that is just a bond fund, so a fund filled with lots of bonds, which are lower risk for lower return. If you can have those 3 structures, that's actually a really good place to start.
Okay, so this 3-fund portfolio that she's outlined here, is this enough diversification for you guys, or is it a little bit lacking? What do you think?
Yeah, I think in general it's great that there's diversification of multiple funds, and there is some global element where it's not just one specific country. I will say it is only 2 countries in this case, though, versus more global diversification. I feel like the bond piece actually stood out to me because, in general, what's the reason for having a bond fund in your portfolio, in this 3-fund portfolio in this case? From our perspective and our mindset on this, with that long-term time horizon, right? Until we're closer to retirement, we're not mixing in these fixed income investments into our portfolio. We're focused on growth and the equity side, and then getting the diversification from more global investing. So I guess that's our mindset on this, is that it would be 2 different countries, and then the US, your home country, and bonds. And in our case, you'd want more global diversification, less asset class diversification. But it's nice that it is diversified on the onset. You're not putting all your eggs in one basket.
Yeah.
Am I hearing this correctly? You guys are poo-pooing bonds for young investors. Is that what I'm taking away here?
As a high level, I guess, as like a one-liner, yes. It depends on the situation, but for us.
I mean, over time, right? It still goes back to risk tolerance, which goes back to education and confidence. Yeah. If I think back to when I got my first job, when I was choosing what type of portfolio that I wanted for my pension, I selected a 60% stocks, 40% bond portfolio, not having any idea, just knowing that, bonds are supposed to be safe, which I think is kind of the general sentiment for a lot of people, but you don't really know the reason as to why you're having more stocks or more bonds or whatever the case may be for your portfolio.
So having a purpose for it.
Having a reason for the things that you're doing within your portfolio is very important.
Okay, makes sense. Appreciate you guys playing along with that segment here. Now, obviously, we've talked a lot about asset allocation ETFs here today. So on that note, I want to throw it over to my colleague, Caitlin Cormier. She's going to show us how you can screen for these funds in WebBroker.
All right, we are going to go into asset allocation ETFs. So in order to get to these, we're going to click on Research, come under Tools, and click on Screeners. Once we're here, we're going to go ahead and click the ETF tab. I have actually already created a screen here, but let's just go back and see what criteria was used to get here. I have selected fund category, added criteria, and chosen Canadian Global Equity Balanced and United States Global Allocation. There are other categories that may fit that you're welcome to look through and find if they'd be more appropriate for what you're looking for. There's also a number of other criteria you can add to filter down these results even further, like management expense ratio, holdings allocation, dividends, lots of different info so that you can kind of filter down further. I have deselected mutual funds, and I'm going to go ahead and select to view my matches. Once I am here, I will see a number of results here. As I look through, you can see there are ETFs that have words like growth, asset allocation, and the like in their name, which gives me the indication that I have some results about what exactly it is I'm looking for. You'll notice there are some that have other things like, for example, potentially covered call, and that sort of thing in the name. So you do have to make sure you do the appropriate research to make sure that these ETFs match your objectives. But as you see, I can click through and see some additional information on each of these ETFs, including any ratings available, performance, risk information, as well as holdings allocation. There's not a whole lot typically available under sector. Some of them may have information available, but the one that could be very helpful is choosing geographic region. And here you'll actually be able to see how much of the fund is invested in different areas within the world. So you can choose the ETF that kind of fits your specific allocation requirements. And remember, we can always do a comparison of ETFs as well. So if I just wanted to take a few different ETFs here, I can choose up to 5 and click the compare button. And this will show me a side-by-side comparison of these ETFs, of all the information that we have from the screen. And if I do choose one particular ETF that I'd like to do more research on, I can click on the name of the ETF, click on Summary, and I will get to the overview page for that particular ETF, and I can kind of dive a little deeper into the specifics to decide if this particular ETF is the right one for me.
All right, thank you so much for that, Caitlin. Steph Den, thank you guys for filling us in on your approach to keeping things simple through all this market chaos over the long term. We're not done yet, though. We're going to open the floor, and we're going to take some questions for viewers. How does that sound?
Cool. Awesome.
All right, let's see what we got here. I have one coming in here from Jace, and Jace wants to know, what criteria helped you choose one asset allocation ETF over the others?
Yeah, great question. So a few things with the asset allocation ETFs, the main way that they're actually specified, or the different categories, is based on the allocation of stocks and bonds, or equities and fixed income. Yep. So you'll see that there's all the way from largely bonds, low stocks, all the way up to 100% equities. So in our case, when we're talking about choosing our one asset allocation ETF, it's the one that had 100% equities in it. And then there's multiple different companies that offer them too, and they're all largely similar in Canada by geographic breakdown beyond that. So it's pretty much up to you.
Yeah, it's up to you which one you want to choose. Yeah, for us, it was, we knew that we wanted 100% stocks within our portfolio, and whichever one had that, that's the one we went with.
Yeah.
And any other criteria beyond that? Like, I'm thinking MER or tracking error or anything like that? Anything that jumped out to you guys, or no?
Yeah, that's it for sure. We'd obviously look at all that. In terms of in Canada, they're all fairly similar, the different ones. Even the MERs are fairly similar too. But yes, looking at the price is a big one, and in general, what the different geographic breakdowns are too. If you're looking at different all-in-one ETFs, that's where you're going to see a lot more variety. The asset allocation ones that are available in Canada are fairly similar to each other if you're looking at it from that side. But yeah, looking at price, looking at the geographic breakdown too, those are big.
Okay, good rules of thumb to follow here. We got another question coming in, this one from Anthony. Anthony wants to know, will one ETF for a retired person like myself be appropriate because it also provides some income?
Good question.
That's a good question.
So it depends on what the actual fund is, of course. Could it be appropriate? Yeah, potentially, because one fund could include multiple different funds that have different focuses, right? So it just depends on what you want in your portfolio. There could be one fund that makes sense for that too. It just depends on the actual situation. Again, it's actually looking for what you need at that stage in your investing journey and approaching retirement, and is there one fund that actually fits that criteria for you?
Yeah.
Yeah.
Any thought, just as like a side question, any thoughts on like covered call ETF funds and stuff like that? Like those are obviously really big in income. I know retirees really like it. Do you have any thoughts on those, or is that outside your wheelhouse?
Yeah, good question.
Yeah, I think for us, we've stayed away from at least the covered calls area.
Yeah. It's a good point, though, talking about actually receiving income from your investments, especially as you get closer to retirement. We're big on reinvesting your dividends when you're younger, because, again, we're going for growth over the long term. But when you get to that stage where you actually need some of your income from your investments, there's some room to play around with that a little bit more. But yeah, something to go more in depth on.
Yeah.
Okay, we got another one coming in from Steven. Steven wants to know, would you sell a pool of ETFs at a loss now to reinvest in a single diversified ETF?
Interesting. It's a very specific question here, too. Okay, so a pool of ETFs to get in one single one. So they have multiple different ETFs then that they're buying individually. Would you sell the pool of them at a loss to invest in single ETFs? It's an interesting question talking about timing, because in general, right now we're obviously going through market volatility and we're in this dip phase. In general, let's say that we weren't and we were talking about this. For me, when I changed up my strategy, going from a robo-advisor to investing on my own, I technically sold all those ETFs that I had. Yep. They happened to not be at a loss at that time, but I sold them and reinvested. That was very scary for me at the time. It was the biggest purchase and sale I've ever made in my life, if you look at it that way, of divesting in one and then reinvesting into something else. What got me through it is building up that knowledge and confidence gap, realizing that over the long term, this is a very small amount of money compared to what I'm going to have in the future. So I think it's important to look at it from that lens. Do you need to do it right now? Are you motivated to do it because of the dip? That shouldn't be your motivation.
Yeah.
It shouldn't be because things are down and you want to get out of them and sell at a loss. That's a panic state, right? And you don't want to be in that phase. But in general, if you're looking to simplify your portfolio and go into one ETF, that's a different question and different situation.
I'd also love to know what kind of ETFs. Like, are these passive ETFs? Like, are these ETFs where over the long term are, along with the market, eventually going to trend upward? Or are they very specific ETFs that are very sector heavy and are potentially going to, be down for the foreseeable future?
That's such a great point, because you can change up your strategy by adding to it and no longer contributing to something and starting to invest in something else without selling it. That's a huge piece to recommend too. Yes, it just depends on what these actual investments are and what the future is for them.
Yeah. Okay, great perspective. We got time for one more, and this one is coming to us from Davis. And Davis wants to know, I've seen reports that institutional investors are increasingly worried about the U.S. economy, and they're moving to various safe haven assets, gold being one example. why are you guys comfortable going against the smart money, so to speak, by staying invested in equities during this time?
Yeah. I think the biggest thing, again, is going back to what we've seen historically happen in the past. Every time that these things happen, that there's this dip in the market, that there's a crash, that there's concerns, it could be for a different reason, but the outcome ends up being the same, right, over this long-term period of time. So if you're, and again, it's kind of recycled language too, where every time, go back and see the reports from the 2020 crash or the pandemic crash, 2008, like you mentioned, dot-com bubble, all of these different crashes in the past. What was the language people shifted to these different asset classes during that time over the short term? Again, we're very young in our investing journey. We're investing passively for a very long period of time. There's no need for us to do that in our portfolio right now. We have time, historically speaking, to ride out those dips and go back up over the long term.
Yeah, I also don't think that retail investors or retail money is dumb money. Like I do think there's a lot of value in the people who are investing passively for the future, and
good point.
Yeah, I just. Yeah, I guess I'll leave it at that, yeah.
Okay. Well, appreciate you guys filling us in on your perspective here. Great questions from the audience here. That's all the time we have, unfortunately, for today. So thank you so much for joining us. Really appreciate it. And to our viewers as well, really appreciate you tuning in as well. Make sure you check out next week's episode. This is a real good one. Okay, you've heard about the 4% rule for retirement spending. Well, DIY investor Blake Hilgeman will share his strategy that he believes will allow him to safely withdraw, get this, 6% of his portfolio each year. And he's got the data to back it up. So for now, that's all the time we have. From everyone at Inside Investing, thanks for joining us. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.